There's a lot of FOMO, and that's driving valuation of companies around AI. And AI is like other pieces of technology that we've seen come and go, but this one we all, I think, generally believe is going to be around, it's going to be transformational. As a tool, AI has the ability to drive some efficiencies across the enterprise. Now, whether or not that displaces human capital, we see a lot of writings about this on a daily basis that quote AI is going to take everyone's job. But at the end of the day, what AI doesn't have the ability to do is to exercise judgment and context, read conversations, and actually perform that human element that only humans do and do well. And so AI is an enabling efficiency driver, but not always an effectiveness driver because of that inability to apply context. They're only as good as the data they're trained on, and not all data is publicly available.
Welcome to the latest episode of the Raise&Exit podcast. And today I'm honored to have with you Patti, who is going to go and share not just from his background and his experience, but what he's also going to go and share is a whole bunch of questions that he's been asking, and yes, I'm going to date him a bit, decades, in terms of his experience. And I invite you to listen differently from today versus other podcasts, because Steve is going to be sharing with you his experience from being at the large customer level, but also being at the small organizational level that is trying to grow, that is trying to raise capital, that is trying to sell. And it is a very different perspective because you'll be able to hear from the same voice what it is like to be on both ends of the spectrum. So on that note, Patti, welcome to Raise&Exit podcast. Please expand a bit more on your background for the benefit of our listeners and viewers, and then we'll take it from there.
Edgar, great to be with you, and hopefully, as you said, listeners will take away some things that they'll find valuable. I've got a work career that spans just about 40 years, and that's been split into small and medium enterprise as well as Fortune 500 employers, as you referenced. I'm a two-time entrepreneur, having built a $6 million and $20 million company. Both were service companies. I have been an advisor to small and medium businesses seeking to exit on the M&A side. I've also been an employee on PE-backed roll-up tech companies in the hundreds of millions. So we're talking about mid-market. And so my experience spans multiple continents. I've worked in 12 industries. I've held W-2 roles as a CMO, a CRO, and CEO. And as I said, I'm also an entrepreneur, founder, and a 10-year adjunct professor in entrepreneurship. So quite a blend of experiences across industries, continents, and formation types, small, medium, and large, W-2, 1099, advisor, et cetera.
Steve, thank you so much for providing that context. And I've known you for quite some time now, and I've just learned even more about you today. So let me go and dive right into what I think is a theme that you and I have gone and explored for some time, which is the risk that is there today in forgetting the useful practices of the past when it comes to scaling companies. And I don't mean just scaling companies based on product, based on marketing, based on revenue. What I would actually go and put in is the human factor. And that's what I've noticed in our conversations over the years and my reading of what you've gone and published religiously. Could you just unpack what is the human part that cannot be forgotten about in the age of AI, in the age of automation, in the age of alacrity?
Yeah, and I think we're starting to see some of this emerge in at least a lot of the things that are being published in media and even our daily LinkedIn feeds. But there's a lot of FOMO that you spoke about in the October conference at the Silicon Y'all conference. There's a lot of FOMO, and that's driving valuation of companies around AI. And AI is like other pieces of technology that we've seen come and go, but this one we all, I think, generally believe is going to be around, it's going to be transformational. As a tool, like other tools that have come before, AI has the ability to drive some efficiencies across the enterprise. Now, whether or not that displaces human capital, we see a lot of writings about this on a daily basis that quote AI is going to take everyone's job. But at the end of the day, what AI doesn't have the ability to do is to exercise judgment and context, read conversations, and actually perform that human element that only humans do and do well. And so I think that from my perspective, AI is an enabling efficiency driver, but not always an effectiveness driver because of that inability to, again, apply context. And the other thing we know about LLMs and training models is they're only as good as the data they're trained on, and not all data is publicly available. So AI doesn't know what's in my 40-year work history if I haven't published it or trained an AI model. So I'll always have context, as you will, that is just like a walled garden in terms of talking about attribution and data. They're walled gardens in our heads. Unless that information has been made public, AI can't access it. Now, there's then the whole concept of synthetic research. Well, we don't need to talk to Edgar and Steve as smart guys because we'll just create synthetic lookalikes. But again, it comes back to the AI and its decision-making is only as good as the data it's been trained on and the scenarios it can recognize from a trending. So I think, my POV on this is simply this. Valuable, yes. Replacing executive teams, no. And I think we're going to see more careful and slow adoption in highly regulated industries where you think banking, healthcare, certainly, where personally protected information, certain data sets, you're just not going to typically put that in AI training regimes, or at least not without careful consideration, because of the downside risk of X percentage efficiency you might gain. You could have 10X of risk if that data enters public domain or somehow puts you at a regulatory or data breach or IT security risk. So I think there's some things to be played out there that I'm a little bit more pragmatic on. Definitely a game changer, but I'm not necessarily worried that, executive decision makers are losing their job next Monday morning.
I love the transition because you just went into, I think, what I still feel is an understated coverage of the topic on my own podcast series about Raise and Exit, which is around risk governance and risk management. And a big part of what I go and talk about is a lot of people forget that the valuation of your company is material based on de-risking it, not just going and driving revenue and margin. And and thank you, Steve, for walking right into what I'm going to combine as my next two questions, which is the notion of de-risking as a valuation driver in smaller organizations, call it founder-led, versus de-risking as a valuation driver in larger organizations, such as your private equity background experience. So maybe you can dive into both, maybe as a juxtaposition or a compare and contrast or in sequence, whatever works for you. But I really want to lean into your experience on the notion of de-risking as a valuation driver, because I've seen companies that have spent $1 into de-risking gain more in the valuation than spending $1 into driving revenue. So what do you have to say about that?
Yeah, I agree with that. And so a couple of things. Number one, as an entrepreneur, I mentioned at the top here, I started two, small but very profitable companies. I was in my 30s at the time, and I personally, put together what I called a personal board of directors. They weren't an investor board because I bootstrapped both companies, but they were guys with 10 to 15 years more experience, one in legal, one a COO, one that had done, a lot of M&A and all that. And these three individuals all gave me the same advice in separate conversations, that you never should develop an entry strategy to launch any sort of business endeavor without already visualizing the exit strategy. So starting with the end in mind and working backwards. And let's just take a 5-year or 7-year time horizon, roughly a VC or PE window. So in those cases, going back to my two examples and the two companies that I had built, even though they were small, I thought I used the same kind of heuristic and mental models as a PE firm would look at building, putting $100 million into a $400 million company for, say, growth capital. And that is this. I believe that de-risking is largely the same from small, at $5 million transactions to 500. It's just that the opportunity cost of getting it wrong goes up significantly. So de-risking, number one of the things that I realized building two sub $20 million companies is that if I wanted to exit and I didn't want a 5-year earnout, I wanted out in a year, 18 months, 24 months max, I had to institutionalize knowledge and process and data that outlived me, where at the negotiating table, the buyer, typically one of the ways to de-risk it is, I want handcuffs on you and key members because everything is up here, and should you, quote, the figuratively get hit by the bus, the investment is at risk. So one of the things that I did very early on, like in years 2 and 3 of building these two separate companies, is literally color code the 9 different functional departments in the company I'm going in the time machine. You talked about dating each other, right? So I used a tool called Visio back in the early 2000s that, Microsoft, I think, acquired.
Yep.
It was flow charting and mapping, and I literally printed out on a 12-foot long conference room table. I had about an 8-foot by 4-foot, massive Visio flow chart of all the operating processes in the marketing consulting company, which was the $20 million business that I had built.
I just got to intercede, Steve.
Yeah.
Those are still necessary. You can't pull back far enough. It's like going and looking at a Monet. You can't look at a Monet from an inch away. You can't look at a Monet from even 10 feet away. Sometimes you need to be 40 feet away to really go and get it, to see the picture as it is intended. So that's just my little intercede here. And back to you, because it's a risk that we have, and then we're looking only at a 16-inch screen. Sometimes we need to look at the 16-foot picture of it.
That's 100% correct. So as I'm moving the screen around and I'm mapping and I'm checking logic and kind of decision points, I really just said, hey, even though it's old school, this is back maybe in 2002, I'm going to print this thing out, take it in our conference room, lay it out, and I want to stand back, call my functional directors in, et cetera, and say, hey, what have I missed? What do you see in the frontline trenches that I'm not seeing? But I really want to institutionalize and document process. Now, this was not. I was already in the M&A mode in years 2 or 3. We hadn't hit revenue, EBITDA, some other things I'm going to get into here with de-risking, because I kind of understood what I probably needed to show up with in terms of presenting the business to a potential buyer. One of them was around operating models and operating efficiencies, documented process. But the other thing it allowed me to do is go back then and say, have I built the org chart to align with these processes? And if not, which one needs to change? Adapt the process to the organization structure, or the organization structure to support the process. It also allowed me to go into the JDs, the job descriptions, and fine-tune every job description about the tasks and the expected outcomes and all of this. But I immediately started with organizational alignment. So de-risking, I think part of it starts there, because when you want to sell a business, ultimately the buyer wants to scale. Profitable paths to growth, and a lot of things that you talked about last October with regards to the strength of the commercial model and, not just historical trailing business performance. What's the 3-year outlook of the hockey stick, the proverbial hockey stick? So de-risking, I think, starts with, number one, an operational rigor around, do we understand the processes, the people, and have we that are necessary to drive those efficiencies, and if we structure the organization accordingly, down to job descriptions, incentive and reward systems, et cetera. Because here's what we know, jumping to PE, because you talked about let's compare and contrast.
Oh, Steve, I'm going to have you to pause that, because I just had a big aha listening to you, which is the components of the de-risking. There's de-risking the revenue curve. There's de-risking the revenue retention. There's de-risking the transition to new ownership. And then there's actually de-risking the capital transition, especially if you have investors into the existing company, because they actually need to be able to see that they're going to be getting their return through the sale, not just in the return in the paper valuation. So I just want to kind of park that from my observations as a guide, because I think putting those 4 factors in with that PE lens that you're about to walk into, that's a completely different calculus right there. So back to you.
And it is. And when I put the $20 million company on the market for sale, we had a combination of potential buyers, and 2 of them publicly traded. So what they just simply did is looked at, EBITDA times a multiple for share valuation and said, hey, if we're buying you for 20 or 21 million, basically just pulling your earnings into the mothership here, we're going to, at a stock valuation, end up driving 35 or 38 million in market cap. We just funded the damn thing, right? But for privately held companies, or even publicly traded, that want to not only cover it just on cap growth, they still, to your point, want the runway of, hey, show me that I'm not going to walk into an organization that's built on Excel and spiral notebooks with handwritten notes, because that's not scalable infrastructure, particularly if they're a larger, more mature organization. You talked about something last October, which is one of my talking points here I was going to hit on, which is kind of the ease of integration. So ease of integration starts with the operations. Do you understand the processes that you run every day? Have you optimized those processes? Do you have organization and people in the, quote, right seats on the bus? Because a lot of times what happens in an acquisition is they want to collapse the SG&A overhead, right? They want your revenue streams. They might keep some of your sales force, but they want to get rid of your accounting people, this, that, and the other that just is an SG&A overhead. And part of it is we need to understand the processes to know if we could absorb them with our existing OpEx, SG&A team. So for the sake of time, we could talk for an hour just on operating efficiencies and how to position for that. But part of this goes to if you know the kinds of companies you might want to sell to and how they operate, right? Again, starting with the end in mind and working backwards, this gets in even bigger topics around positioning, but aligning operating models. Now, I don't say copy someone else's model, but you know where I'm going. Contextualize even the way you talk about your operations in their love language, which leads them to the first checklist. Operationally, can we swallow this and integrate it in a relatively frictionless or pain-free timeline here? So the second one then that going back to your question, I think around de-risking is, okay, so hopefully the house is in order in operations. The second house that is in order, that strategic operating partners for PE firms typically get told, right, by the investor group, hey, we're putting you in on this account. First thing we're looking for is operating efficiency. Second thing we're looking for is data integration and data clarity. Everything from pipeline and all of the forward-looking revenue components through to the growth and expansion of the customer base. To a variety of things that ultimately we know who the recipient is, and it's FP&A, right? Financial planning and analysis within the finance group. So this is why you have the rise of RevOps functions and everything else. But operationally, if you can prepare that business, even if you don't sell it as the founder or founders, you gain from operating efficiency. You benefit. So the exercise is worth it, whether you sell or you want it to be a lifestyle business, or you're going to hand it down to your 40-year-old kids one day, whatever the case may be, whatever the strategy is for the business, and it may not be M&A, you benefit from operating efficiency. You benefit from the data strategy and integration around, we're not going to have all the silos around the company. We're going to have augmented accurate data. We're going to look at schema. We're going to look at reporting. And oh, by the way, this is where AI agents can help drive efficiencies, especially if you don't have large IT teams, et cetera. So you got operations, you got data. The third one is pretty obvious, and I talked to 6 or 7 PE firms here this month on how they think about de-risking investments. So ops is one, data is second, and the third is organic growth. So obviously, PE firms can roll up, but there's a curve. You can't just keep rolling up and buying revenue. What they're really interested in is, can you show me what you talked about in October, which is after the acquisition, not just certainty around your financial performance leading up to the data closing, but can you show me, give me predictability, give me confidence in what growth might look like thereafter. So you've got a couple of leading indicators, right? There's past performance, but also depending on the commercial model and kind of the growth vision that hopefully those founders or executive teams are pitching you, here's where we see winnable addressable market opportunities. You talk a lot about saturation. Have you squeezed everything out of those markets, or is there still growth to be had? The fact of the matter is that I've talked to 6 strategic operating partners in PE in the last 30 days who say even in mid-market companies in the $400-500 million or more in revenue, their collective comments were typically they don't hire great sales and marketing people, or typically they don't have great sales and marketing processes in place. Typically, they have a directional understanding of how they're acquiring business and closing it. They don't really have an intentional, formulaic approach that can be scaled. And that's another risk that even if they put you on a 2 or 3 year earnout, once you're gone as the seller, are they left holding a business that in a BCG matrix is not a star, it's maybe a cash cow or a question mark.
Yeah.
And it flattens off. So a lot of the projections that they had, which, oh, by the way, operating partners are usually compensated on, hitting EBITDA targets, right, and paths to profitability. De-risking is around, can we, the VC investors or PE investors, can we help these businesses create repeatable, as much as repeatable can be repeatable, but some sort of predictable or repeatable organic growth capability. And so there's pillars there. Now, I've got a few notes here off screen that, I made that in addition to what those 3 pillars I just mentioned, operations, data, and organic growth engines that PE people have told me, strategic operating partners and investors. I also have a few from my own experience that I typically look at, and one is around the strategic fit of your company in the buyer's portfolio. So, are you just a collection of revenue streams and EBITDA that they acquire, strip out all the people, gut it, and just bring a book of business inside and try to ingest it, and they keep the key executives and account people around long enough to make the account transition? Or does your business have either business process patents or other IP, maybe it's not patent protected, unique positioning, even within a strong commercial model, you're uniquely positioned within that commercial model, or is there some other know-how that actually helps their other portfolio companies operate more effectively? And I'm going to give you a real-life example to help illustrate this. So when I put my $20 million marketing consulting firm up for sale in 2001, one of the suitors to buy it was Omnicom out of New York, the large ad agency holding company. They had just bought Razorfish. They had bought a bunch of digital agencies because digital 25 years ago in the emergence of e-commerce, it was a gold rush. It was the FOMO we're seeing with AI right now. If you didn't have .com on the end of your URL, or somehow we're talking about how you were going D2C with .com, or had this big digital vision, you're already in a laggard position, right? So Omnicom was on a mad acquisition tear. And one of the things that our not agency, I shouldn't say that because that was the one thing I told our employees, we never use the A word, we're consultancy, and that has to do with positioning evaluation, by the way. But one of the things in our consultancy that we had built an expert practice around is intellectual property licensing. So movies, music, the digital gaming, downloadable and unlockable digital rights management, DRM, before the iTunes store came out. So we're working with Bertelsmann Music, Sony, Warner Brothers on testing DRM and devices, and how to build business models around shareable music and content that had been previously prepackaged and sold in retail. So we had some very specialized practices at multi-billion-dollar companies and industries like music and movies and entertainment were being disrupted. We had Napster. It was audio sharing files illegally among users, and it threatened the entire music industry, right? So we had built this unique practice. So what Omnicom realized is that the expertise we had developed in building encrypted systems and in developing and testing DRM models, things like this, they were serving other clients globally that had this problem, and therefore our little $20 million company throwing off maybe $3 million in EBITDA was worth far more than 2.2 times revenue, I think you quoted in your speech last October, that a lot of your clients average, right? Because it would be a jewel in the crown that they could walk into a lot of other clients and not only win their traditional marketing business on a 3 or 4 year client pitch cycle, right? So let's say they're selling $60 million in traditional agency services. This thing became the shiny object to not help them renew existing business, but unlock other revenue opportunities. So again, we'll park the bus here. But Bruce Reddit, I remember the guy's name, the senior vice president at Omnicom, gave me a couple pieces he came down to look at the business, I think in 2000, and said, I love everything about it, but I'm going to give you a couple of homework items that will de-risk this acquisition. Yes. I'm going to come back in a year, in 2001, summer of 2001, and I want to see how far you've gotten. Well, one of them was around me developing kind of the playbook of how, if they made the acquisition, we could help unlock revenue in the rest of the portfolio. The second thing, though, is diversification of revenues by market and service type. So they came down and looked and they said, hey, 60% of your client revenue is in technology. So 12 million of the 20 million. And of the 12 million, half of that, 6 million, was with one client, Dell. And right away, he said, too much concentration risk. So he said, I don't want you to dilute your 12 million in tech revenue. I want you to find not just 8 million in other revenue, which made up the 20, but I want to see that 8. I want you to grow another 5 or 6 outside of tech.
Yeah.
And as a rule, we don't like seeing maybe one company, one client being any more than 25% of the revenue within a sector. So I had a revenue diversification strategy challenge to go out and diversify these other areas. Now, whether Bruce ever bought it or Omnicom ever bought it or not, that was super helpful because I'm thinking, yeah, just like I diversify my own investments, not being all in on, small cap stocks or whatever. That makes a hell of a lot of sense because when you're printing money and we were growing quick and making a lot of money, I don't want to say I didn't care where the money came from, but if it's hits the margin targets and we're getting 3-year contracts and everything, I'm not going to tell Dell, no, I'm only going to take $3 million of your business because you throw my ratios off, instead of taking the $6 million. I'm taking that extra $3 million. But what it forced me to do is become more intentional in looking at percentages of revenue and EBITDA by sector and by accounts within a sector to diversify it. So if any one count left the building, I've just de-risked the hit to financial performance for the acquirer. And so that diversification, along with ease of integration, along with strategic fit in the buyer's portfolio, to me were 3 additional pillars that go with what the PE firms have been telling me here in 2026 around operating data and organic growth. So there's some data points maybe we can riff on, or you can take it anywhere you want to go.
Oh man, I am like hammering at my keyboard on the side, taking notes just off of what you're going and saying. So I'm going to put a couple of things here as we're coming to a close of this. Could you take, as kind of like a closing statement, I think, for benefit, going back to my original theme of how I opened this, there's a human element which actually really hasn't fundamentally changed. So if you look back now versus a quarter century ago,
right,
what hasn't changed if you think about it?
I think what hasn't changed, as corny as it sounds, is what you just said, the human element. So let me give you examples of what that means. So even if I could have had AI 25 years ago, and the same statements I'm about to make is how I would think about it as a CRO today. AI is an amazing tool for analyzing large volumes of data, creating trend spotting, maybe extrapolating the trend spotting into a couple of war game scenarios, high, medium, low on growth curves, upsell and cross-sell potential by accounts. There is a lot of automated kind of due diligence and thinking. I think about it, my wife worked in a law firm for years. I think about what paralegals do to research for cases versus the trial lawyer. Having AI agentic paralegals, right? Amazing. So, but at the end of the day, I think the human elements are still this. Once that insight is presented, ultimately, unless we're going to get into true agent-to-agent buying, you've got to have someone with the competence and the confidence to take that and still make, get it the last mile, so to speak, to make the human sale. So an AI, I believe, is an insight enabler and a time saver that frees up people to do more people work. So what does that mean? Deepening relationships with accounts, including catering to the fragile ego executives and the people that always need to be right in the room, or the people that don't have confidence in making a buying decision to buy from you. So AI could enable a whole preponderance of you've done the vetting and the scenario analysis for them, and you're presenting them with information in a nice, simple narrative that helps them have greater confidence in their own decision-making. And this plays to like what Brent Adamson has just talked about in releasing the book, The Frame-Making Sale, right? About this idea that oftentimes buyers don't need more information. They need more confidence in making the right decision. And it's that
Wait,
fear
Steve, are you talking about de-risking?
Wait a minute, de-risking decision processes, right? So I think that back to the top, I mean, again, AI, if I were designing an org chart all over for my consultancy business, AI are my, $100,000, junior, 2 years out of a top 10 school, $100K and 25-year ago money, analysts that maybe I don't need as many of those because built correctly, those agents are doing the analysis work. But you still need that, quote, junior partner level guy, the engagement manager, that it actually goes in and can literally, and I have done it many times, taken the Sunday call from the client who's got to make a big decision to invest in you, and they're just not sure. They just need, kind of the shoulder to cry on, or the person to soundboard with, or off the record, Edgar, I've got to have your word that, if this doesn't work out, you're going to save my backside, right? I've got peer executives that this cannot go sideways, whatever the case may be. And I don't think that's going away. And for listeners, I'll share another little tidbit you may not even be aware of. But back in 2017 and 18, before COVID, ironically, over about a 14-month period, I got recruited by IDC, right, research analyst firm, Forrester, and Gartner. 3 different opportunities.
Yeah.
IDC was, a relocation to Boston, actually run their CMO advisory group. I wasn't interested in the relo, so I passed on that. I was trying to see if they'd split it and all this. But Forrester and Gartner were to join their CMO advisory practice. And I remember having dinner with the woman that runs the practice in San Francisco for Forrester. And she was describing kind of we'd been through the process and we're kind of in final, just having a one-on-one dinner meeting. And she said, Steve, part of this role is one part expert advisor, right? You have to have the head knowledge and the notches in the belt. You've been there, done that, right? But the other part is counselor and therapist. She said, we're going to assign you a basket of, say, 10 accounts where you're an advisor, a 1-to-10 ratio of advising 10 CMOs at 10 large Forrester accounts. And you have to be okay with the idea that they may be having a nervous breakdown on a Saturday or Sunday. They're going to need your cell phone number to call you or whatever, and that you may need to give up an unexpected 45 minutes of your day on a Sunday afternoon trying to watch football or whatever, because they just need someone to turn to that they can soundboard an idea with or express emotional insecurities or uncertainty. And then at the end, have you give them the encouragement or the confidence they need to make decisions. And so when I read on LinkedIn that AI is going to put Gartner out of business and all that, look, there will be some insight gathering that maybe agents, cannibalize over time. We'll see. But the human factor is this. If I'm a CRO or a COO or a CIO about to make a massively important decision that presents possible career risk, I sure as heck probably want to talk to a few people that I respect in a similar role who have made similar decisions. And if they're not immediately available in my professional network, I need a watering hole or an oasis where I can go to get that insight. So I think those types of settings, unless we become a completely desensitized digital society of very lonely and isolated people with probably skyrocketing suicide rates where we don't actually have interpersonal interactions anymore, and I hope I'm long dead and gone if that happens. The fact is that last mile in any business transaction is still people sitting across the table from people, sizing up your character. Can I trust you? Because contracts are only as good as the people that sign them. And that, I don't think, goes away anytime soon.
All right, Steve, sometimes I really wonder why I don't run 1-hour episodes. Because I could have easily let you go for an hour on that, but we got a little bit of time here. One of the things that I just jotted down for myself as you were speaking through this was the having you as the business owner have a very clear of being able to articulate to both investors and especially in an exit scenario of how you are de-risking their replacement cost of revenue and replacement cost of staff / technology. And I think that is a de-risking element that I don't hear enough about in negotiations, which is essentially mitigating replacement cost that would be there. So that was a huge one that I had as a takeaway. And then the other one that really just jumps out to me, and I know I try and get this across to a lot of people, but they don't get it until they've experienced it, is how much more companies are willing to pay to lower the risk of acquisition. And that was your example that you went and gave about that call, right? Let me come back to you in a year and see what you've accomplished. Man, that hit so hard. So that was like 2 of the 3 things that really stuck out for me. But what did you kind of get from revisiting some of your experiences, what I threw at you in terms of questions, examples, etc.?
Well, I think in addition to de-risking, that's the defensive set of considerations, right? You got pain and gain in life, and people typically are more interested in removing pain than achieving gain. So if you're an investor buying a business, the first place you're typically going to start is what are all the risk factors that could turn the deal sideways, or we don't materialize EBITDA targets and revenue growth and all that. So you're right. De-risking, I believe, is the lead initial narrative. And you just articulated a couple ways you can de-risk the perceptions investors might have of either putting money in as a minority investor or doing an outright 100% acquisition. So that's the defense. I think as a business owner, you need to do that, because if you don't do that, you're probably not getting the multiple or getting a transaction of any multiple. But I also, as a sales and marketing guy, also like thinking about the offensive, not just the pain mitigation, but the gain acquisition here. That is this idea that I talked about earlier about how the acquisition could fit into the portfolio of existing businesses and potentially unlock growth beyond the sum of your own EBITDA. So for instance, one area is, hey, we, the acquired business, may have a set of accounts that are attractive to the acquirer for which they have demonstrated prior interest, or maybe they've got some initial footprint in terms of market share, but they're certainly not where they want to be. So we could talk about that as an accelerator to the land and expand strategy. Either they want entry into the market and they don't have it at all, so the acquisition represents a footprint by which to grow expansion revenue, incremental markets, or they have a presence there, but they maybe haven't been growing at the rate or landing the kinds of accounts they want. So that acquisition can give them a bigger slice of the pie, so to speak, but also the acquired company is probably doing some things on the sales and marketing side better. And the proof in the pudding is they have more relative share and sets of accounts. So one is the acquired company has share or named accounts. The second is the acquired company may have capabilities that the acquirer lacks. And if they look at their own CRM data on major deals they lost, it's because they couldn't tick the box. They couldn't answer the buyer's question around, are you guys also able to do X or Y? The acquisition helps to tick the box. Now, let me just give you a blue sky illustration, right? Going back to my Omnicom Bruce Reddit example of I'm coming back in a year, I want to see diversification of revenue to de-risk, right? Let's come 25 years later from 2001 to 2026. Let's say I was doing this deal. I had my $20 million marketing consulting firm up for sale, and Omnicom was looking at an acquisition. Let's just say that one of the areas that Omnicom, like a lot of ad holding companies right now, agency holding companies are getting a lot of pressure, is, hey, you guys are just basically a large overhead vendor of a lot of people. And in the age of agentic AI, I, the customer, can automate a lot of things, and potentially we're seeing this cannibalization of revenue from major holding companies. Dentsu, a lot of them, right?
Yeah.
They're all trying to scramble. Imagine if I had agentic capability to automate workflows and drive marketing efficiencies, and that was a capability Omnicom didn't have, and by acquiring my company in this role play, I now have capability that they can take into their 30 or 35 companies in their portfolio and say, hey, when we're going up for account review on a $25 or $35 million account, and one of the things to win another 3-year renewal that we've got to be able to do is tell the account how we're going to help be more efficient in the next 3 years around the use of AI to automate media buying or automate research or automate production tasks. So we have to have the narrative, and if we don't, we may not get the $25 million a year over 3 years or $75 million account renew. So an acquisition that brings that capability inside the acquirer to help protect existing revenue that they have and or open up new revenue is not about new accounts or new markets. It's about capabilities that contribute to retention and expansion of the acquirer's own set of accounts.
Man, I love that, because
unlock to me speak powerfully, because the numbers I just used. So I'll go back again real quick.
Yeah.
I was trying to sell my business. We had a 19.5 or $19.7 million offer. So let's just call it 20 for rounding error. I could spend all my time trying to show Bruce and the Omnicom guys how to de-risk a $20 million acquisition, or I could quickly reframe this to, let me show you how you can protect 60 and $70 million accounts. If we even do one, it has 3 times the revenue and potential EBITDA impact, is like sifting through my business looking for nickels.
Man, I'm going to completely reframe my third point to something way simpler because of what you just went and said. What would it cost you not to buy my company?
The cost of doing nothing, the cost of inaction, right? The
Yep.
classic. I have actually used this following sentence with Omnicom, and at the
Yeah.
time, Texas Growth Fund, which 25 years ago was around $600 million PE firm, they wanted to buy, I think, $8 million for a 30% stake in the business.
Yeah.
I said, I don't really think, gentlemen, we're having a conversation about whether you can afford to buy the business. I think we're really having a conversation about whether you can afford not to buy the company.
That's exactly it. Oh man. I don't think enough people go and do that as a discussion for them, right? Like it's like what, like if you don't buy my company, what's your alternative, right? And that actually goes and tells you, is this a nice to have acquisition or investment, or is this actually a mutually beneficial? And I think it's that mutually beneficial part that not enough people go and take a look at. And this kind of goes to what I feel is sometimes this artificial abstraction that has been created by so much capital that is there to be deployed from LPs, from pension funds, from insurance cos, venture funds, venture studios, whatever the hell it is. We're like, we got to go and deploy capital. And I'm like, look, like, why are you even getting married with this company? Right? And it's
Yeah.
and I think that's the piece that I think is missing in a lot of these situations. Like why are you investing? Why are you buying? What would you invest into or buy into instead? And if you can't go and explain that there is no better allocation of capital than this right now, you probably shouldn't be making that allocation of capital. And it sounds brutish, but
Well, and even I'm going to build on your point, going back to, again, I referenced, in the first segment, your
yeah,
October of 2025 Silicon Y'all presentation, right? Well, one of the things that you listed is some of the pillars that drive valuation is timing.
yep,
Timing. So on the timing, kind of thread line here, going back again, because we're having a little fun with this Omnicom example from 25 years ago. Because I'm a sales personality, this type of framing comes very natural to me. But again, if I were role playing with you as the SVP at the time, Bruce, I'd say, Bruce, look, at the end of the day, ultimately you could pass on this $20 million deal. It'd be a bump in the road for a multi-billion-dollar holding company. But let's fast forward, 12 months from now. If $100 million in client business leaves the building, how do you sleep at night knowing that a $20 million acquisition may have stemmed some or all of that? It would have given you a 5x multiplier in year one. So how do you have peace that you were looking the gift horse in the mouth, decided to pass, and now you're scrambling to try to build capability, which you may be able to, but it might take you another year, and therefore maybe another 100 million leaves the building. Now you're 200 million down, and so you're at a 10x, buy versus build trade-off. You could have bought the solution, but you blinked, and now you're going to try to build it. And oh, by the way, it can be a lot of things. We've seen this in a variety of examples. So, it's a make versus buy trade-off. But framing is powerful, right? And I remember going way back in the time machine to 1996, 95, 96, I was taking some Harvard executive courses of continuing education. And of course, there's the famous acronym of the BATNA, B-A-T-N-A, the best alternative to negotiated agreement, right? And I was taking executive, negotiation, all this. And, framing alternatives is a powerful skill. So in a acquisition, if you're the potential acquired business, it really helps to show up having a deep understanding of how the different potential acquirers, let's say you have 2 or 3 bids, hopefully you do, how they make money, what their key strategic initiatives are, what their current holdings are, the performance of some of these current holdings. Because if they've got, going back to BCG, they got a couple of dogs or question marks in their portfolio, and you sit down and spend 10 hours thinking about how your company might be able to turn those into cash cows or stars, figuratively here. You come to the conversation being able to frame value is, yes, it's part of the collective EBITDA over some period of time times an MPV calculation. But there's other value unlocking that happens across your business that gives us a 1 + 1 = 3 type of leverage multiplier.
oh
And
man,
we frame this not about comps, because here's the problem with comps, and you did a beautiful job in your 20-minute presentation of why comps can be misleading, and comp averages particularly, right? Because you've got a scatter plot of 30 comps and you take an average, but you've got, 2x to 19x and all. There's too much variability. But the problem with comps is they're only looking at the financial aspect of the business. They're not looking at the strategic impact it could have inside the acquirer across other dimensions of the acquirer's business. It's looking at it as a standalone cash machine. It's not looking at the unlocking, the leverage, the how does this make selling what you already sell today easier because you have this adjacent service, or how does this address leakage or exiting, churn in customers, or how does this contribute to expansion sells in your installed base? How does this help you win more net new logo deals in your core business versus we're running this business over here that you acquire? I mean, there's so many dimensions. I agree with you, and I think the reason it gets overlooked, particularly in small businesses, let's call 50 million and under, even 100 million transactions, is a lot of times these leaders were really good at inventing a product and gaining some traction, whatever, but they may lack the business acumen to be able to strategically think about what the right acquirer or acquirers look like. The industries are going to come from these value unlock plays because what they're often searching for is anybody with a pulse and, I used to say a pulse and a PO, but in this case, an M&A bucket of money, right? I don't care who we sell to, if we get 3X or 5X, blah, blah, blah. And to your point in your October, presentation was, man, you're not availing yourself to insights that the acquirer has that the acquired doesn't, and to really understand the true value of the business. And I'm taking everything that you said and saying, not only is that correct, but I think there are additional value plays to add even more premium that are not stretch, what I call Star Wars out there. The stars have to line up, but pretty practically speaking. And you can even build that into the payout on the deal, which is to say, create incentives that say, look, if we're able to help drive business in your other divisions X, Y, and Z over a baseline, take a 24-month rolling baseline, adjusted for seasonality and some sort of trend line on growth. You've been growing at 8 to 12% a year, fine. But any incremental lift, we want a percentage of that, acknowledge that that is value that was directly attributable to the business. And I've done deals like that before.
Man, I'm going to kind of close out on my side, Steve, because what I just realized that I think is so critical, and I'm realizing I'm understating this because it's so unconscious in my thinking, but I'm going to kind of put it on the record for the Raise and Exit podcast is can you explain your transaction without using dollars and cents? And if you cannot, don't do the deal. And it seems so paradoxical because everybody wants to look at CAGR and dollars and EBITDA and valuation. And I'm like, explain to me. Sorry?
They're table stakes.
Yeah.
That's expected. That's expected. If you can't come to that, you don't even have audited financials. I mean, conversation over. Those are kind of assumed competencies.
Yeah, no, this is, oh man, it's a gold mine. I'm looking forward to seeing almost this whole debrief after the session fully ingested by the team. So Steve, thank you. I think we're going to have to park like a 1 year from now and let's reflect on what has happened in the world as people have listened to you from today's session. So thanks.
You got it.
Oh, what a great way to close on just the whole theme of today. Thank you. I learned so much. I am going to have to take this one and just go and take my half page of notes and add it as an addendum, I think, just off of the Steve. I'm so honored. Thank you for joining us on Raise and Exit and just combining decades of wisdom into 32 minutes.
Hey, I appreciate the opportunity. Hopefully it's beneficial to those that dropped in.
Beautiful.